Welcome back to another Market Insight. We are joined by another guest this month, and it is going to be very technical, and that's because he is a professor of economics at the University of Tampa and a fellow of the Mises Institute. Dr. Newman, thanks for joining us.
Thanks for having me on, Chris.
Well, I think it's best. I know you've done a lot of work on inflation and interest rates, so I think that's probably the best spot to really start. There's a lot of talk about what the Fed is going to do. What are your projections for 2024 for short-term interest rates?
Yeah, so I think as you mentioned, the big discussion is the Fed wants to lower rates. So of course, it's how many rate cuts are going to be happening this year. I think that given January's CPI report, I don't think a rate cut will happen in March. Unless something really bad were to happen, but I just don't see that in the economic data. I think the economic data is still fairly strong. So I think we might see a rate cut at the earliest in May. I think it's more likely that we would see a rate cut in the summer, particularly maybe in the late summer, early fall. I think it's likely to see, I don't think they'll lower rates as much as some people have been estimating right now. I think it's more likely we might see around 2 to 3 cuts, 25 basis point cuts. So that, right now the federal funds rate is around 5.25 to 5.5. So I think we could see it around 4.75%. By the end of the year. I think right now markets are still trying to figure out what's happening to inflation. Is inflation settling around 3% or is it closer to target? But I think we are going to see at least one rate cut this year, though I think investors should be not get too carried away and expect more than like 5 or rate cuts or something like that.
You mentioned the most recent CPI report that just came out and was a little bit hotter than what the market was expecting. A lot of people that track inflation, it may not have been a surprise to you. And we go back and we looked at the Fed's most recent press conference where they talk about CPI versus the PCE data. Well, really, they're looking at PCE. And I know the market initially reacted negatively to some of the CPI reports. How are you looking at kind of the differences between CPI and what the Fed's going to be looking at, which is PCE, to make their decisions?
Right. So the PCE data is the personal consumption expenditures index is different than the consumer price index. It's constructed differently in terms of how incorporating the cost of living, so rent, as well as also various expenses, medical categories. And without getting too complicated in terms of how substitution effects work, when the price of one good goes up, the CPI will weight that good differently as consumers purchase lower cost substitutes. The PCE does that as well, but it also, the Fed argues it does it more accurately. So traditionally, the PCE runs lower than the CPI, right? And so I think, markets, they're still trying to figure out, all right, a lot of the CPI data was driven by owner equivalent rent. And there was also some insurance categories that were very strong, particularly services excluding rent is probably still too high for the Fed. So right now, the big issue is, okay, what's the latest PCE data? When that comes out showing for January, what will those results be? And if they're leaning more towards the bad direction, as was the January number, or the less than positive number, I think you'll see some more negative reaction as inflation is higher than what the Fed wants. I mean, the CPI right now is at about 3%. PCE is a little bit lower than that. The Fed still wants to bring a PCE to 2%, and they're going to be looking at these various categories. And it'll be very interesting to see how the PCE data, when it's released, what it shows.
The Fed is talking about the target of 2%. They've been talking about that for a while. We all know that is what they're shooting for. But we're really coming out of several decades where you had fracking, you had a lot of population growth, a lot of things that were allowing inflation to stay low as factors outside of the economy, factors outside of monetary policy. But a lot of those things are beginning to unwind, I would say, absent maybe the AI and the productivity gains that we can get from that. Do you think that 2% target is a reasonable target that they can achieve, whether they're using PCE or CPI?
So I think it's there's of course the inflation driven by demand side factors such as monetary policy, and then there's the inflation driven by supply side factors, sort of structural factors could still be due to fiscal policy, other types of government policy. I think that 2% is possible, provided that, so excluding the monetary policy and what the Fed might have to do to achieve that, the 2% is possible, though I think it could be a little bit harder to get to with potentially some foreign policy developments. Right now, I think strong immigration, population growth has been keeping wages and other costs muted. I think also the key to having free trade around the world, or low trade barriers, is also very important. Otherwise, it's going to be tougher. And that's ultimately a question of foreign policy. I think it's possible for the Fed to get to 2%. It depends on other government policy. And it also may be more difficult than what some people are envisioning, particularly with the soft landing scenario.
So to summarize your view, is it, because you're saying that you are expecting a couple cuts from the Fed, so nothing like some of these people are coming out saying 5, 6 cuts. We've been in the 3 to 4 range, and of course that changes when you get new data. Are you expecting to see inflation that's trending downward to give them at least the ability to cut a couple times? Is that really your view?
So I think as you mentioned, with the data, I think we would be likely to see at least a cut. Traditionally, the Fed has cut interest rates during an election year. I think that over the next couple months, in February and March, it'll be very interesting to see where inflation is going. I've been mentioning this for a while, that I think inflation is settling, at least the CPI is settling above the Federal Reserve's target around 3%. And if that's the case, then the Fed's not going to cut as much or keep interest rates higher for longer. So I don't want to, predict that inflation is going to be another huge problem again. I do think it is higher than what's expected. I do think there will be at least one cut, 1 or 2 cuts. But I think we need to keep seeing what the data looks like, because I think over the next couple months, inflation could remain above 3%, which is going to push back cuts in the federal funds rate until the summer at the earliest.
Well, let's get into how this affects the economy, and then, of course, the effects to the stock market, which is really what's going to matter from an allocator perspective. You have GDP, gross domestic product, and gross domestic income, GDI, kind of giving a little bit different signals. What's your current state of the economy?
Yeah. So GDP has been pretty strong, all things considered, compared to what people were forecasting. And GDP measures the market value of all final goods and services purchased in the economy. So imagine people spending money at the grocery store, for example. GDI is just the flip side. It's the market value of all the income received from producing those final goods and services. So people spend money at the grocery store, and of course the grocery store earns that income in the form of profit. They pay wages, rent, and so on. In theory, those numbers should be equal. They are collected differently. Since COVID, there's been more noise, you could say, or more of a discrepancy. So while GDP was pretty strong in 2023, GDI was noticeably weaker. And that would be reflected in basically lower incomes people are receiving potentially in the form of bonuses and other types of compensation. So, as with some other economists, some other professional economists, I try to average GDP and GDI, and you get an economy that's still growing. It's just not as much as what some people were thinking with GDP. Unfortunately, GDI comes out at a little bit of a lag, so we won't get the fourth quarter results for gross domestic income until the end of March. And so it'll be very interesting to see what will happen there. But still, the picture, at least so far, is that the economy is still growing. And this is reflected in various other indicators. It's not just these national income accounts. So earnings reports, in 2023, they weren't disastrous. The labor market it has some issues, but it's still holding up, very well. And so I think we can see an economy that's growing, but it's not quite where we were at, with trend growth compared to where we, if we didn't have COVID. So I think the economy was still growing in 2023, looking at the average of GDP, GDI. I don't think it was as strong as what people had expected, but we will see with the latest data. I think moving forward, we could see weaker growth just from the strain of higher interest rates and other things that I'm sure we'll get into. But I think the economy will still be chugging along for a little bit.
So how reliant is the economy, you think, on short-term interest rates, needing them to come down at least a little bit to keep this going?
I do think right now markets, there's been a tremendous growth in the stock market and the S&P since October, with expectations of rate cuts. And this is also filtering into, consumers have been increasing their borrowing. It's above, credit card delinquencies are above pre-COVID, as with auto delinquencies, not where we were in, the mid 2000s. In borrowing for residential mortgages is still strong. There doesn't seem to be problems there. There are issues with commercial real estate, as a large number of borrowers are basically they're expected to repay their loans or to refinance their loans, and that will be an issue. I do think markets are positioning themselves for a rate cut, and if those rate cuts get delayed and interest rates remain higher for longer, which is, I think there's more likely than not that will happen, the economy, both worldwide and potentially globally, will suffer. Will that lead to a recession in 2024 or just stronger growth? I think a recession, if it would happen, would now happen maybe at the end of the year at the earliest. So I still think the economy will grow, but I think it will be slower than what people were expecting if inflation remains persistent and if interest rates remain higher for longer.
Do you put a probability on recession? Because that's really, what the market's doing is discounting some probability that there will be recession, and you get strong moves up in the market when it looks like that probability is moving much lower, and then that's when everyone's talking about really the soft landing scenario, which the market really can be described as just wanting to see inflation come down. Right, that's going to be supportive. The economy, as you described, if it's okay and you have a supportive Fed, the market thinks they're going to get a soft landing. So how are you weighting this, at least in terms of probability?
Yeah, so in terms of probability, of course you have to always look back at your prior predictions. I had predicted a recession earlier, at some point in 2023, as with many other economists. That had not materialized. Growth was strong. The labor market remained strong. Consumers kept spending. The government kept spending. And there also was a big positive technology shock that we are still feeling the ramifications of, which of course I'm referring to as artificial intelligence. I don't think it's a coincidence that the last time we had a soft landing in the mid 1990s, 1995, was right when the internet started to become this big phenomenon and really start to take off. So if we do have a soft landing materialize, I could think a large part of that would be due to artificial intelligence. Right now, I don't think it's likely that we're going to have a recession in 2024, at least until the end. I would put the odds of a soft landing in 2024 over 50%, potentially even 60%. Again, the economy could be slowing. We could be seeing cracks, but the likelihood of a soft landing, I think, is more likely than not, just given the amount of, what would need to happen in order for the NBER to officially declare a recession. We'd have to see a lot more weakness in the labor market in terms of jobs numbers. We'd have to see businesses and consumers really start to suffer from higher interest rates and so on. And I think that, the chance of that happening is if inflation remains higher and businesses continue to have to pay higher interest rates throughout 2024. So I think it's more likely than not that we don't have a recession during this year. I think the potential causes of recession would be if inflation, which has significantly fallen, and I think it would at worst kind of hover around 3 to maybe 3.5% at this rate. Inflation forces higher interest rates. You could see some problems with commercial real estate. Consumers run out of steam. Both of those would be factors of higher interest rates. The wild card here, in my opinion, is with foreign policy or foreign economies. And there's a lot of stuff that could happen in foreign policy that could spook markets, lead to higher interest rates. Foreign economies, for America's doing relatively good. We should be very happy for that. Investors in America should be happy for that. Other countries not doing as well. Japan has at least entered a technical recession. The Chinese economy is slowing down. German manufacturing is very weak. So while those economies might be suffering, that could either help us or that could potentially lead to problems in the United States. But I think for most of 2024, it's likely to have a soft landing. And I'll just finish just by noting the phenomenon of long and variable lags, how it takes high interest rates to impact the economy. The Federal Reserve back in the mid 2000s had last raised the federal funds rate in like July of 2006, and we didn't enter a recession until December of 2007, January of 2008, and that was only retroactively declared the beginning of the recession. So given when the Fed last raised interest rates for us, that kind of puts the timing, if we're to assume a similar cycle, around late 2024, early 2025 at the earliest, right? So there's, of course, things are always different, but I do think I would put soft landing for most of 2024, at above 50%, potentially even 60%.
So there's obviously we've hit market highs again, and that always brings out the scare headlines of it's time to pull back. You've mentioned inflation, and certainly the last CPI print did spook the market some, but it's also started to rebound from that. And a lot of it, some things that Chris has been talking about, this is not just euphoria. There are fundamentals. Earnings have been increasing substantially, especially in these tech stocks. And you've mentioned AI. So my question is have you seen any work where it's like this is more than just hype? We're really starting to see productivity gains because of AI, and it's showing up in technology. Or do you think there are other reasons that they're able to add to their profit margin?
So I think right now, at least in terms of seeing some of these AI developments, I think we're still kind of waiting, but there is strong demand, of course, for computer chips and in building up the AI infrastructure. I, for one, am still very interested to see what Microsoft will do, say, for example, with its various Microsoft Word, Microsoft PowerPoint, and so on. I think AI has fueled a lot of these earnings, and we should be interested in seeing, okay, what's happening with various types of computer chip stocks and other things. I don't think it's all hype. I think regardless of whether there is sort of a run up and a pullback, the internet was here to stay outside of the .com bubble, and so will AI. It's not going away. Right. And, as you mentioned, earnings, I think earnings overall across the economy, if GDP was lying, I think, GDP and GDI would be more accurate than just GDI. But, we would see that also show up in earnings estimates, and we haven't. So I do think that earnings have been strong. I think that the economy, that the stock market still has room to grow again, because I think it was really spooked in 2022 when there were worries of, okay, how bad will this inflation get? A large amount, probably around over half of that inflation was transitory, and transitory in the sense of supply shocks and so on. And as that went down, it made the Federal Reserve's job much easier. So markets are confident, at least, that the Federal Reserve will have the problem contained. I think we will continue to see AI affect various sectors of the economy. A big area to look out for, not just in this year, but in the next decade, I would say, is in healthcare and medicine, and how AI will really improve that industry. But there's a lot to unpack, and having a positive technology shock is a very good thing for markets, I would say, in the short term, medium term, and in the long term.
Yeah, I think maybe our main case, like you said, if there's a 60 or even a little bit higher % chance of soft landing, and the market's moved up a lot, right? They could have priced in a lot of that moving forward. We did. It's not like we made large changes. We raised cash for those in distribution, right? We made sure we brought back some of the risk because we had had outsized gains since the October rally, as you said. But we're not going to you're not going to exit markets to get back in later in the year. Right? That's too much in terms of a timing standpoint. Right? We're just trimming the edges, making sure you're doing prudent rebalancing within portfolios, because as Dr. Newman's saying, there's still a strong chance the economy gets through this.
Absolutely.
Doing pretty well. So you kind of mentioned, really one of the last topics we wanted to hit is really on federal deficits and really that effect on the U.S. dollar, because you mentioned it in these GDP numbers. There is a large government spending number that's keeping GDP elevated. What's your forecast for where government spending is headed?
Yeah, so I think government spending has been keeping up growth, and this has also shown up in the labor market. So an increasing proportion of increasing proportion of the jobs added over 2023 was government employees. This comes with various weaknesses, I think more in terms of long-term growth. Government spending has also increased significantly because of interest payments. And if interest payments are expected to fall, then that would also trim down how large the federal deficit is. I think the trajectory is much more worrisome over the long term, simply because the entitlement programs are going to continue to grow. Military spending is most likely going to continue to go up. And this is going to lead to higher and higher structural deficits, you might say, outside of a recession. So at the end of the decade and the early part of the 2030s, this will become, I think, an issue, and the United States is going to have to deal with that. Now, there are two things to note with this. One, how bad is it in the United States relative to other countries? That's always important. We can't just look at the United States in isolation. We have to look at what's going on in other countries. And if the United States is doing better than other countries, we're just going to global demand will basically, for our treasury debt and so on, will keep those pressures at least relatively muted. So the question is, we could be experiencing slower growth from that debt, but it won't turn into anything catastrophic if at least we're doing better than other countries. And then the other thing is, how would a potential positive technology shock in the form of artificial intelligence, while that won't solve the federal debt issue, it would lead to more growth that would make that debt more manageable. And we need to figure out how that's going to basically work itself out in the in the overall economy. So to just sort of summarize, I think the federal debt's a problem. It doesn't seem like it's going to get solved. This is something I think investors and other people should at least have on their mind. However, it is important to look at how is our government spending relative to other countries, and we also have some good reasons for economic growth that could make this more manageable in the over the horizon.
Yeah, that relative question comes up also with the dollar. I know one of your colleagues, Bob Murphy, just was in a debate on really, I think the topic was called the demise of the dollar, because he thinks there's going to be significant weakening in the dollar, and obviously the other panelists were saying they think the dollar is actually going to strengthen, and most of their case was just a relative component to what other currencies are doing. What's your view on the strength of the dollar?
Yeah, so it's a great question. It's a perennial question. The dollar has been a world reserve currency for actually about 100 years. It happened really in the 1920s, and then we lost ground in the 1930s. But then officially after World War II, it became the world reserve currency, and it's had some ups and downs, but it's maintained that. If we look at, say, the last 25 years, from about 1999 to the present day, as a percentage of foreign exchange reserves, the dollar share has declined from about 70% to 59%. So a little bit more than 10 percentage points. It declined initially with the euro, and then it kind of gained ground against the euro after the European debt crisis in the 2010s. Just another reminder that what happens in other countries matters too. And you have the Chinese RMB that's been gaining ground. There's discussion over BRICS and other things. I think it's more likely than not that the dollar will probably continue to lose ground, especially potentially in some developing areas of the world. But I view it as as more of a slow hemorrhage, right? Because as long as the fundamentals in the American economy are stronger than elsewhere in the world, especially in Europe and in Asia, particularly Japan, right? So we think of our strongest allies are in Europe and in Japan, as well as Australia, then that's going to keep enough strength in the dollar. The problem could potentially be with some sort of foreign policy development with BRICS or further issues with China and Russia. That could lead to further weakness in the dollar, or if people just not using the dollar. But I don't think there will be a significant drop or sort of a crash, if you will, anytime soon, unless there's some foreign policy catastrophe. Just as a little bit of history, the last time a currency lost its world reserve currency, it was the British pound, and that basically took 2 world wars. So, yeah, unless we have those, right? I'm not saying we will, but it'll take a significant drop for the American economy, the dollar, to just sort of completely be discarded. But I do think it will continue to gradually lose ground, at least in the parts of the world that are not as politically or militarily allied with us.
So ultimately, these come down. We hear the full faith and credit of the U.S. government, which obviously the math, when you look at the debt, is problematic. But you continue to mention the relative strength, which I think is important there also. Is there that much more full faith and credit in the Chinese government or one of these BRICS governments, et cetera? So when you're saying lose ground, is it more as just what percentage of the transactions are happening, or is there a significant drop in the value where we see that contributing to this inflation problem?
Yeah, so I think in terms of inflation, I think barring some sort of major crash, at the worst, inflation would be slightly elevated. It would be 3 to 4%, which is still a significant problem, but it's not as bad as say 9%. And then it's of course what's happening in other currencies as well. So if inflation's 4% in the United States, but it's 5% in Europe, well, then the dollar comes off as stronger and people are still going to be drawn to the dollar. The Chinese economy, 15, 20 years ago, people were expecting the Chinese economy to, surpass the United States. And that would have been a different conversation in terms of the dollar. The annual growth rates for the Chinese economy have been very disappointing recently, and investors are not reassured by the government's highly interventionist policies. There's still a lot of lingering effects of COVID. They have various population issues and so on. So I think it's not going to be a one country takes over. And there is the BRICS, which there are the BRICS, I guess, which other countries that are not as politically or militarily allied with the United States. So countries in Europe, some countries in Africa, the Middle East, in South America as well, would join that. Those countries are not as wealthy as the United States, as Europe, as Japan. So they could gain some ground, and we might see a world in which the dollar has another reserve currency potentially. But I think that the dollar status is still fairly secure, and I think it will remain above 50%. And if it does get below 50%, there'll be multiple competitors. It won't just be one other currency. So I guess I'll just stress this. It's always important to look at the United States has problems, but it's always important to look at how bad are these problems relative to other countries, right? And for all of its faults, the United States does have better governance than many other countries, which is why investors, both domestic and foreign, are still reassured by what the United States is doing.
Well, Dr. Newman, thank you for joining us. I really enjoyed the conversation. As promised, it was very technical, but thank you for joining us.
Yeah, well, it's a pleasure to be on. Thanks for having me.
Thank you for joining us. If you want to hear more about the markets or the economy, go ahead and hit that subscribe button, like, and share with someone that you think would find it useful.